introduce our first speaker. His name is Shane O'Brien. He's an investment director from Aviva Investors. Shane has plenty of experience, senior positions in both HSBC and State Street. So without further ado, I'll introduce you to Shane.
Good evening, everybody. So thanks, Alan, and thanks to Finance One for having me today. What I plan to do over the next 10 or 15 minutes is to keep this talk quite high level and hopefully of interest to everybody. I know it's a sunny evening outside, so we'll try and keep it interesting. What I want to do is talk about absolute return funds. Now, in Aviva Investors, we manage some funds. I don't want to talk too specifically about any one type of fund. What I want to talk more about is absolute return funds generally, and why I think that they should be considered for your investment portfolio, if not all of it, at least part of it. So what I want to do is cover three main areas today. I'm going to keep the agenda quite simple. First and foremost, what is an absolute return fund? Some of you will be familiar with this, some maybe not so much, but I want to talk about what it actually is. Secondly, a brief history. I think it's actually quite interesting when you look at the history of absolute return funds. Where did they come out of and why were they created in the first place? And finally, why should you consider one today? So that's my agenda for today. I'll spend roughly 3 or 4 minutes on each of these. Does that sound good? Great, because I don't have a plan B, I'm not going to lie. Didn't bring a second presentation. So first and foremost, what is an absolute return fund? Well, a traditional type of investment would be equity markets, and what you're looking at here is the return of equity markets over 30 years. And the one thing that we can say about equity markets over the long term is that they do go up. And that is what we see over time and time again. If you have a long time horizon and you have patience and you're willing to take the ups and downs, you generally will get rewarded with strong returns. The challenge with investing in equity markets is that there can be periods where the ride is quite bumpy and you can be very unlucky with timing. So just to give you a couple of examples, if you were an investor who invested back in 1999, you suffered a sharp fall off with the dot-com bubble and it took you 6 years to recover your investment. Again, if you're an investor before the financial crisis, while markets have gone up over time, again, being unlucky with timing, investing in 2007, you got a large fall off. Yes, you recovered, but again, it was a 7-year period until you recovered your losses. The point being that investing in equity markets completely makes sense, and it does require patience and time, but you can be unlucky. So when we look at these types of things, we think, well, is there a better solution? And one of the solutions that has been created is an absolute return fund. Now, an absolute return fund, in theory, says that, well, we can get returns in all conditions. It will give you returns, or aims to seek returns irrespective of what's going on in markets. So this is what you're looking to achieve. Hopefully this works, yes. So this is what an absolute return fund should look like. Now, I should stress, this is simply a hypothetical line. This isn't a fund that's been in existence for the last 30 years. But the theory of an absolute return fund is returns that are somewhat similar to equity markets over the long term, but without the ups and downs. Now, just a couple of things I'll point out about this hypothetical line. What you'll notice is that it is obviously straight, but you will notice that at points in time, equity markets go way ahead of it. So at points in time, even in an absolute return fund, you probably would have been better off in the stock market. But what you'll obviously notice is that when you get the large fall-offs in the stock market, you shouldn't so much get them in an absolute return fund. So how does an absolute return fund, at least in theory, manage to not fall when the market's falling? How does it manage to get these returns in all market conditions? Well, it's interesting if we take a step back and think about where an absolute return fund came out of. An absolute return fund is derived from a hedge fund. And a hedge fund is something that some of you may or may not be familiar with, but it was created by this guy, Alfred Jones, in 1949 on Wall Street. And he basically said, everybody here is making returns from the stock market. Well, why can't I make returns if the stock market falls? So why are we always dependent on the stock market going up? I'm going to take some positions that do well if the market falls. And he had a pretty good track record, and he created what was known as the first hedge fund. That was in 1949, and it came to prominence throughout the 70s. These two guys, Ray Dalio and George Soros, who are now known as the two biggest hedge fund managers, they're still in existence. They created their funds in the early 70s to mid 70s and had huge success with hedge funds. And these hedge funds were basically saying, well, we can generate returns in all market conditions because we can take positions that will benefit if the market falls. We can maybe take positions that can benefit if bonds fall in value. The point being, we're not so dependent on the stock market doing well in order to generate returns. You may be familiar with films like Wall Street, The Wolf of Wall Street more recently, and these were based on guys who are hedge fund managers in the US, and they've made lots of money and had great lives on the back of hedge funds. Now, the interesting thing about hedge funds and the challenge for us as investors is to invest in a hedge fund. Quite often it can be extremely expensive. Usually fees are anywhere from 2% up to 5%. Usually there's a 20% performance fee on top of that. Usually the minimum investment level is in the millions. It's quite a hard thing to get involved in, and it's also quite hard to know what your returns are likely to be, because a hedge fund, while you can make money in up and down markets, they never quite tell you exactly how much they're planning to make. So they can be quite risky. So what happened was a guy called Ewan Monroe in 2004. He was working for Standard Life, and this guy took the whole premise of a hedge fund and said, well, why does it have to be so expensive? Why does it have to be so opaque where we don't know what they're actually putting positions on? Because with hedge funds, quite often the hedge fund managers don't want you to know what their positions are, because they don't want everyone to know what positions they're taking. They want it to be opaque. So Ewan said, well, why don't we create a fund that's a little bit less opaque? Why don't we create one that's a bit cheaper, it's more transparent, we have some risk controls, and why don't we put a return objective on it so that when investors go into this fund, they have a clear expectation of what they're going to get. And what this guy created with Standard Life was the GARS fund. And the objective of that fund was to achieve a cash plus 5 return in all market conditions. He created that, and when he created it, the Standard Life company backed him when they put their pension scheme into it. And in 2006, they created a fund, which is available in Ireland, and it had a huge amount of success. This became the biggest fund in Europe. It attracted 50 billion in assets. And you can see the track record of it here. This is showing you the MSCI World, which is the blue line, that's the stock market. And you can see the return of the GARS fund. So this was an absolute return fund looking to achieve returns in all market conditions. So what's interesting here is his timing was quite good, because he launched the fund a year before the financial crisis. So his timing was pretty impeccable. And the track record was pretty good as well, because what you can see is the blue line falls quite substantially. The black line does what you would hope it would do, in that it's a lot more solid, and it looks to achieve returns in all market conditions. Now, the black line, while it's going in a general direction, an upward trend, that's not to suggest every year was positive. You can probably see some years from the chart there. 2007, 2009 was kind of flat. Again, from 2011, 2012 was flat. But what you can see is there's an upward trend, and even though markets are falling, it's done quite well. And if you actually look at the objective, which was cash plus 5, versus those returns, it's achieved that. So that was a very good news story. The reason why that chart ends in 2014 is because in late 2013, Ewan Monroe left Standard Life. And this made a lot of headlines. In my world, in the investment management world, this was the equivalent of Messi signing for Man United or something. He left Standard Life and went to Aviva Investors, which was a surprise to a lot of people, because he had such success with Standard Life and the GARS fund, which, as I said, at the time had grown to be the biggest fund in Europe. He joined Aviva Investors, which is where I work. And when he joined, there was a lot of media attention about it. But he was joining what was quite a large investment manager of its own accord. These are some of the stats on Aviva Investors. The assets under management in Aviva have grown quite substantially since Ewan came in. Ewan is now the chief executive of Aviva Investors, but it is a large investment manager with a presence all over the world. But when Ewan came in, he created a new version of the Standard Life GARS fund. He created a new absolute return fund with Aviva, which he called AIMS. He grew it. He brought a large number of he brought some of the individuals from the Standard Life team with him into Aviva to create this fund, and he added more and more team members, and that fund has grown over time. And what I wanted to show you, I don't want to dwell too much on any one particular fund, but I just wanted to show you quickly what the returns have been like of the Aviva Investors fund, the AIMS fund. So similar to the Standard Life fund, this fund is looking to achieve a cash plus 5% return. And as you can see, it launched in July 2014. So Ewan started in Aviva Investors in early 2014, and within 6 months he had this fund up and running. And it operates very similar to the GARS fund, in that what we are trying to do with this fund is deliver returns in all market conditions. And how we do that is, we are not just dependent on stock market going up, we can take positions that will benefit from the stock market falling, but we can also take positions on a whole host of different things, like inflation, like interest rates. So there's a whole different variety of investments that we can choose. What you can see from this chart is the blue line is the stock market over this period of time. The green line is the return of the absolute return fund, which is AIMS. Now, what's been disappointing for us is that, as you can see, the green line has been quite flat for the last couple of years, whereas the purple line, which is our objective of cash plus 5, obviously has gone in a straight line. So what's been positive has been the rocky road that you see with the stock market, the blue line. You can see that our fund has given you a smoother journey, but it's fair to say that it hasn't achieved the returns that we would have hoped, and that it hasn't delivered the cash plus 5 objective. Now, our belief is that the positions that we hold in this fund, and we continue to hold, we strongly believe that they are well positioned to do well in this market environment. And I know that Alan talked earlier about the uncertainty in markets at the moment. And I think right now, today, we're in an unusual position in that we've had 5 or 6 years, actually even more, almost 10 years now, of strong equity market returns. We've also had a backdrop of interest rates continuing to fall, which means bond values have gone up. So we've been in this, in some ways, perfect conditions for a traditional simple fund which holds equities and bonds, and they've performed incredibly well. I guess the point that I think is important to maybe take home from today is that just because those types of traditional assets and investments have performed well for the last decade doesn't mean they always will. And sometimes you do need a different type of investment that can perform a bit differently in market conditions. I mean, this is the chart that you saw earlier, which shows you long-term equity market returns. You can see from the chart on the left-hand side that obviously equities are at all-time highs again. In Aviva Investors, we're still quite positive on equities. It's not to say that we think there's an impending collapse, but it's fair to say that at some point in the future, history will repeat itself and we will see some sort of a correction or some sort of a fall in equity markets. And it's important to have, within your investment portfolio, to have something that acts a bit different to that. On the other side, as I mentioned, you have bond yields. Bond yields have continued to fall. Alan mentioned this earlier, how a 10-year Irish government bond today is giving you a yield of 1%, which isn't a great return. So that means they're expensive. So you've got equities doing really well. You've had bonds that have done incredibly well. Well, maybe today it's worth considering something that's not just a traditional simple fund, which, yes, may have performed well over the last number of years, but might not always. This slide just summarises how we think the world looks today and how it reflects in our AIMS fund. And within our AIMS fund, which looks to achieve cash plus 5% in all market conditions, if you start to see these kinds of things coming true, you will likely see our fund performing well. And I suppose the simple outlook is we're actually quite positive still on the stock market, on equities. We think things are quite good. We expect inflation to come back. We haven't seen inflation, or strong inflation, in developed markets for some time. We're starting to see some signs of that. And in our fund, we have positions that actually go up in value as inflation comes back. We are expecting interest rates to go up. We're expecting bond yields to go up, which is usually bad for funds. Our fund is positioned to benefit from those. We take very select positions in various different emerging markets which we can benefit from. And one thing that we haven't seen in a while is just general volatility in markets. Markets have been very calm and very subdued, and as I mentioned, they've behaved quite well. We are expecting that market conditions won't be so calm, won't be so subdued going forward. And in our AIMS fund, we have positions that can take advantage of that. So maybe just to conclude, I guess when we think about absolute return, I think it's important to bear in mind that these types of funds have the ability to generate returns in different types of market conditions. And when we compare these types of funds to more traditional funds over the last number of years, the more traditional funds can and have looked better. But that's not to suggest that they always will. And from my perspective, I think that when we look at the last 5 years and we look at how conditions have been and how favourable things have been, it might not be too unreasonable to think that the next 5 years will be quite different. And if you do believe the next 5 years will be quite different, it might be time to consider something alternative, something that can give you a smoother journey, and maybe you'll consider our fund AIMS with Aviva Investors. So thanks for that. I know that we're going to open up to questions later, I think, so I'm more than happy to take more specific questions on the fund or a strategy. But with that, I'll pass it back to Alan. Thanks.